Hey guys, we're going to go over some misconceptions today that you've heard about the lending side of a real estate deal. I've got Tyler here with me, and he's going to help us get through that, and that video starts right now. What is your background? What have you done?
So I've done real estate, buying and selling, helping people purchase. I've done investing myself. I've got rental properties, and also doing mortgages. And so coming at it from kind of a full spectrum there.
Yeah.
And I've helped lots of people, and just really like helping people strategize on what's the best mortgage type? What's the best route to go? Should I get this type of loan or this type of loan? And how much should I put down? Should I buy down the rate? Like feeling those different questions and helping them navigate that process.
Right.
I enjoy doing that.
That's awesome, man. That's awesome. And that's why you're good at what you do, honestly, because of that. And so the first question that I have for you is, what specific steps can I take to improve my credit score before I make a purchase of a home?
Yeah, so there's a couple different steps specifically that you can take to improve your credit score. I would say if you don't have credit at all, you can become an authorized user on somebody else's credit cards.
Okay.
Like if you have a parent or somebody else that is willing to let you be an authorized user, you can become an authorized user, and that history, their payment history on that card, their usage, their limit on that card basically gets applied to your credit report.
And you can do that for a family member, right? And not give them a card. So
Yeah.
like they don't have a card,
Right.
like they're not going to
They're an
use it.
authorized user, but they don't have a card to
So
use.
like they're getting credit.
Yeah.
They're getting credit, but they
Yes.
don't actually physically have a card. So they're
Yeah.
not out spending money on your credit
Yeah.
cards.
So that's a good way to help people that just have not borrowed money before.
Okay.
Maybe kids that are wanting to buy a house,
Right.
or even like adults that just never borrowed money, which is great. I mean, that was the case for me when I bought my first house. I think I was maybe 19, and I had zero credit because I bought everything I ever had with cash.
Right.
I was very
Right.
financially responsible.
Yeah.
Always pay cash for everything, and but I didn't have a credit score. I didn't have there was nothing for them to base that on, like to actually prove my credit worthiness, for them to give me.
It's that no credit is just as bad as bad credit.
Yeah.
Type of thing,
Yeah.
right? So
So that's one way to establish credit quickly, is to become an authorized user. And then another way, and this is something that I do for a lot of clients that I specifically do, is what's called a rapid rescore. So let's say your credit score is a 600, and you have $10,000 in credit card debt.
Right.
That you are in a position where you're able to pay it off. Well, it usually takes 30, 45, 60 days for that payoff to reflect on your credit score, which sometimes is usually longer than the purchasing process.
Right.
So you're not gonna get the benefit of paying that off while you're actually buying. Now, if you're 6 months out from buying a house, then paying off those cards, getting your usage, your credit utilization down below 50% is a threshold, and then down below 30% is another threshold.
Okay.
So like, let's say you have 10,000, 3 cards, and the total is like $10,000.
Right.
And usually it's like each card has its own utilization. Like this card has a $1,000 limit. Well, if you use less than $300 of that $1,000 limit, you stay below that 30% threshold.
Gotcha.
That's going to be better for your credit.
Okay.
If you go past that 30, but stay below 50%, like you only go up to 500 of that 1,000 limit, it's not as good as the 30% or less, but it's still okay.
And this is something that you map out for them?
So when I run their credit, I can see what their utilization is on different cards.
Okay.
And I actually have a program where I can, it's basically a simulator. And it's usually conservative. So I can plug in payoffs into the simulator, different things. Like, all right, if I pay, $53.60 off on this card, where does that put the score?
Right. Okay.
So I can adjust and try to get the minimal amount of payoff for the maximum benefit to the score.
Gotcha.
So I look at each credit line, if they have multiple cards or like a car or something like that, what's going to be the most benefit for them to pay down or pay off. And then it'll calculate the score after that's done, what that should be after that's done. And it's usually conservative. So like, let's say they're at 600 and they have 3 credit cards, and through my simulator, I can see that, hey, if you just pay off $500 on this card, your score goes up to 660, right?
Right.
That's going to get you, or 640.
It's going to save
where
you a
you're
lot
going
of
to
money.
be able to do conventional, or
Yeah.
you're going to be able to, right? Or just going to get a better rate,
Right.
or something like that.
Yeah.
Which some lenders don't even go below certain credit scores.
Right.
So it's
Yeah.
like if you're below 640, some lenders won't even touch it, or 620, and that's another benefit with Thrive is, we have lenders that go down to 500. So
Wow.
you can literally get a loan with just about any credit score.
That's awesome.
And now there are certain terms and conditions
Parameters
that apply,
of course. Absolutely.
and the rate may not be as good because
Right.
there's more of a risk
Absolutely.
there with a lower credit score. But if it's the difference between getting in a house and getting and not, that we have that option.
I mean, that's the credit game and lending game. It's
Yeah.
risk reward, right?
Yep.
So I mean,
Yeah, the less risk for them, the better deal you're going to
the
get.
better reward. Right. That's awesome, man.
But those are some ways to help boost the credit score. The rapid rescore is a way for me to instantly have their credit score reflect those payoffs. So it's basically like if paying that $500 down on that card would get them from a 6 to a 640, rather than having to wait a month or 2 months for that to actually reflect on their credit score. I can do a rapid rescore. We get a payoff statement from the Chase,
whoever the credit card
company.
Okay.
We submit that to the credit company, and they use that payoff to instantly change what's reported on your credit and update your score.
That's
so
awesome.
you get a new credit score.
Yeah, that's awesome.
Yeah.
Is there cost around that?
There is, but that's something that I cover.
Okay, so that's something you would handle. That's awesome. Wow, that's good stuff right there.
Yeah. I just actually had somebody that we did a rescore. They were at 7.125. And after I did the rescore for them, they were at 6.65.
Man, that's awesome.
Yeah.
See, and here's the thing, I'll say, that's why it's so important to, find individuals that this is what they do for a living and not listen to your Uncle Harry, right?
Or Google.
Or Google. Because I have so many real estate clients that will be like, well, so-and-so told me this. And I'm like, well, what do? Well, they work in a factory. You know what I mean? They don't understand that there are, other opportunities, other paths, right? So that's why it's so important to reach out to a good lender, a good realtor, and really, really ask those questions and find out the truths. So number two misconception, that I have on here is going to be, is the 20% down payment really necessary to buy a home?
Yeah. So 20% is good if you have 20% to put down on a home. Typically with conventional loans. If you do put 20% down, you're going to avoid paying what's called private mortgage insurance.
Right, PMI.
And that's really the biggest benefit, other than just owing less and having a smaller payment.
Right.
But 20% is not required on really most loan types, including conventional. So in fact, you could have zero down on conventional, on FHA, on VA. Most of those loan types that people typically go with. Qualified mortgages, we call them.
Right.
A lot of them have down payment assistance programs where you could come to the table essentially with zero down payment.
Okay.
Some of those are in the form of grants that are forgiven. Some of those are in the form of grants that are forgiven over a period of time. And some of them are just incorporated in the mortgage.
Hey, do me a favor. Like this video. Subscribe to my channel.
Gotcha.
Essentially, when you
Well, that's gonna jump us right here into number 3. So number 3 is how can I determine which mortgage product is the best fit for my financial goals and lifestyle? That's a good one because I think that confuses a lot of people. Like,
yeah, I think it's going to depend on what your goals are, what your intentions are, why you're purchasing the property. If you're buying an investment property, there's a couple different products that are specific for investors.
Okay.
That might be better, or just might have the flexibility to do what they need. For example, like a lot of self-employed borrowers, realtors,
right.
people like that, want to write off as much as they possibly can. So they're showing as little income, so they pay as little taxes as they possibly can.
Absolutely.
Well, what happens to most people when they do that is they go to purchase a home and get a loan. They're like, oh, well, it looks like you make $30,000 a year.
Right.
We can't
You have
qualify
no
you for
buying-
anything.
You have no
right?
buying power.
Yeah. So with most conventional loan types or qualified mortgage types, like conventional FHA, VA, things like that,
Right.
that income piece is very important.
Okay.
But we have what's called a DSCR loan, right? So DSCR is debt service coverage ratio.
Right.
So specifically for investors.
Okay.
So if you're buying an investment property, it can't be for a primary, but if you're buying an investment property, you can get a DSCR loan, and it's not based on your income at all.
Right.
So they don't even look at your tax, your tax records, anything like that. It's essentially based on the mortgage amount and whatever the average rent. So they do an appraisal for the value of the property and how much rent that area
that you can
generate.
get.
Mhm.
Okay.
Yeah. So as long as the rent, and they have some different options in there, like you can go below, like even if the rent was below what the mortgage is, they do
Right.
have some options there, but typically you want to stay 1.25% or 125% over what the mortgage amount is.
Gotcha. Okay.
So for example, if the mortgage is $1,000 a month, you want the rent to come in at $1,250.
50. Yeah.
You don't have to have a tenant. You don't
Right.
have to have a lease agreement in
Oh,
place,
wow,
anything
okay.
like that. So you're purchasing this property, you don't own it yet.
So you don't even have to have any of that in place. It's
No.
like as long as the numbers crunch and they work out.
Yep, they
That's
do.
awesome.
They do an assessment of what the rent should be,
Okay.
and as long as that comes in at like a 1-to-1 or higher ratio,
Right.
then you're essentially good. It does also work off of your credit score. So you need, in most cases, you need at least like a 660 credit score to get a DSCR loan, and then most DSCR loans are going to require 20% down.
Which is not bad. 660. I mean, that's.
Yeah,
I mean,
that's-
honestly, that's
Fairly
that's,
low.
yeah, it is. That's not like a super high credit score, like
Yeah.
a 750 or 800. So
Mhm.
that's awesome. Quick question I have for you is Thrive Lending. So what makes Thrive different from a lot of the other lenders? And I know because him and we've had this conversation, but I just wanted to kind of let you guys know, like, hey, this is what Thrive does different from a lot of other mortgage companies around here in the Nashville area.
Yeah. I would say the biggest difference for us is we're a mortgage broker.
Right.
So we shop multiple different lenders.
Okay.
So right now we have, I think, about 50 different lenders that we shop with. And these are wholesale lenders,
Right.
right? So these are different than like a bank or a retail lender, right? I won't name any names or anything like that, but
And that's what you're going to find. Honestly, a lot of times you're going to find retail lenders, and what you're doing, that gives you guys more power, I believe, like to get better rates and things like that.
yeah, it's having access to low rates, but also just having more flexibility. Like if you're going to a bank or a retail lender, they have their underwriters, and if they're underwriters, and a lot of times they have overlays, right? So overlays are basically like guidelines or rules that they have on top of the normal guidelines or rules that come from like Fannie Mae, Freddie Mac, right? That make it harder for borrowers, right? Because it's just extra things that they're going to require. And so that flexibility there, most of the lenders that we work with have no overlays. So it's just based strictly off of the Fannie Mae, Freddie Mac guidelines.
Okay, cool.
And that's one thing that helps. And then the other thing I was talking about with underwriters, you know, the underwriters are the ones that are requiring or asking for you to meet those guidelines. Okay. So they're in charge of making sure that this loan meets all the guidelines and qualifications that their investors require.
Right.
So if their underwriters don't like something, you know, there's a bonus that you make and they don't want to count your bonus.
Yeah.
Like, oh, we need to show 6 months of you making that bonus in order to qualify you or whatever.
Yeah.
Well, that could be an overlay, right? That could be different than what the actual guidelines are. So having no guidelines helps there.
Right.
And then in addition to that, like this is something that you kind of find out as you get into the back end of the mortgage process is, you know, a lot of the guidelines are kind of gray, and it's up to an underwriter's discretion in terms of what is going to be required there.
So it's left up to that individual.
Essentially.
Wow.
Yes.
Okay.
And they may have a manager, they may have like a senior underwriter that's also looking at it. But essentially, like, you know, you go to this retail lender and they have their underwriters, and if their underwriters say no, then that's it.
Yeah.
Deal's done.
Yeah.
You don't get the house.
And I've been there. Like I've had deals where I actually just had one. It was last month, I believe, and their lender was a retail lender, and something popped up. I think it was actually the seller gave my buyers money, and I didn't. And it was like, here's your 3 options now. Like, this is going to kill the deal. And I'm like, for them getting more money, and they're like, yeah, because it falls outside of our guidelines. And I'm just like, oh my gosh.
Yeah.
Like,
yeah, that can happen. And so if that happens, you lose a deal. Whereas, like for us, because we work with so many different lenders, each of those lenders has their own underwriters. Right. So if we have the loan with this lender and the underwriters don't like something and it's going to kill the deal, we can pull that loan and we can put it with another one.
Yeah, you can pivot and still keep the deal on track. That's awesome.
Yeah.
That's awesome.
And so we can, you know, we have account executives with each of these lenders that we can talk to before we do all that and go, hey, can we work this out?
And I'm sure working with these lenders too, like you get to know, like you're like, hey, this deal is good for this one. This deal is good for this one, right? And so you can kind of pick and choose like who to take them to and know that, hey, I'm doing what's right for my client.
Right.
You know, and that's, to me, that's awesome. Like that flexibility makes a huge difference. The two of us, we know, because we've done a bunch of real estate deals, like, you know, these things are extremely important because you get into a position where, like he said, you know, something changes in the deal, and just because it's outside the guidelines, if you're with one retail lender, you know, this bank, and they kill your deal, I mean, you may have just lost your dream home, right? And that's really, really, I mean, that's not what we're here for. We're here to make dreams, not kill them.
Yeah.
Let's see, so number 4, and this is a good one. What additional costs should I anticipate beyond the down payment when purchasing a home?
Yeah. I mean, what you're going to find, you know, most often with that is closing costs. Right. I mean, also you have to consider like moving expenses and, you know,
do I have to buy
repairs,
a washer and dryer if they don't have one? Or
anything that isn't in the house, new furniture,
blinds, dude. I never realized so when I first came into real estate, I never realized like, oh, this home doesn't have any blinds in it. And then
no big deal.
No big deal. And then your client goes to buy blinds and they're like, dude, it's like $2,500 in blinds in this house. Yeah. Like they add up quick. So
that happens a lot with new construction.
Yeah, absolutely.
Because they don't put that in.
Yeah.
You know?
I actually came across a builder yesterday because you guys know I do home tours. I came across a builder and they were including blinds. And I told these people, I was like, that's a huge expense.
Yeah.
That's a big saving.
It's a plus for
Yeah,
sure.
it is, absolutely.
Love it when they throw in stuff that, that the buyer's not considering.
Right.
But when it's there, it's like, oh man, that was actually great.
Yeah, absolutely.
Yeah.
Absolutely. It's better for them to add stuff than take away.
Yeah.
We'll definitely say that. So,
So the biggest thing is closing costs.
okay.
Outside of your down payment, you're gonna have closing costs. Now, closing costs are something that incorporates a lot of different fees and costs and prorations and different things. You've got taxes that have to be paid. Here in Tennessee, taxes are paid in arrears, so paid at the end of the year.
Right.
So typically, when you go to the closing table, like let's say you close in June, the seller is responsible to pay for January to June, and then the buyer is responsible to pay for the rest of the year.
Right.
That they live there. The seller pays for when they live there.
And that's where we talked about so I had never heard. I've been in real estate a long time, and because I'm not on the lending side of it. I don't really handle that side of it. I never realized, and he brought this to my attention one day. Was like, hey, you realize that whether they close at the beginning or the end of the month changes their closing costs. And can you speak to some of that?
Yeah. So one of the pieces of closing costs is prepaid interest. So depending on when in the month you close, or what day, like if you closed on the first of the month, you're going to have 29 or 30 days of prepaid interest, which could be $2,000 or $3,000, depending on the rate and the loan amount, things like that.
Right.
So that is going to increase your closing costs by that much. However, if you close on the first of the month, your first payment, like let's say you close on a house June 1st. So you're going to not have a mortgage payment in June. You're not going to have a mortgage payment in July. Your first payment is going to be August 1st.
Wow.
So you get to skip 2 months. Essentially.
Yeah, that's crazy.
But you pay 30 days of prepaid interest.
Right.
So your closing costs are higher, but you kind of have that benefit of not having payment for 2 months.
Right.
So it kind of depends on like each person's financial situation.
True.
If they're needing more money on the front of that deal for moving expenses, buying the washer dryer, things like that,
Right.
then it may be better to close at the end of the month. Because if you close on the 30th or the 29th, you're not going to have much. You may have 1 day of prepaid interest, which could be $50, $60.
Okay.
And that's going to decrease your closing costs by $2,000 or $3,000, which is huge. Yep. So if you need that, but then your payment is going to, so like if you close June 30th, you do still get to skip July, but your first payment's August 1st.
Okay.
So if you close at the end of June, your payment's going to be August 1st. If you close at the beginning of June, your payment's going to be August 1st.
Right.
So the difference there is whether or not you pay more prepaid interest, or you get the benefit of skipping 2 payments.
So in other words, what he's saying is when you call us so that we can do your real estate deal, you're going to be like, hey, James, can we move this to the end of the month? And Tyler, can we move this to the end of the month?
Yeah, that's something totally negotiable in the deal.
Absolutely.
Hey, we want a 45-day closing.
When we write the contract, we can write that in, and we can put in there, hey, here's the date we're looking to close, and we could try to save you though, save you that money or skip those 2 months,
Yeah. What I have found is that most agents will just, put the closing date 30 days later when they write up the contract.
Right.
But that's something where James is great because he can help strategize, partnering with a good lender who's going to help strategize and figure out when is the best closing date.
Absolutely. Yeah.
And don't schedule it on a weekend.
Yeah,
that's happened too.
Yeah. I don't think I've ever scheduled one on a weekend. So
it's like, oops,
I'm batting 100 on that one.
Yeah. Nice. Yeah. But that's something to talk through on the front end is like, when do we want to close?
Right.
And here's the difference that can make.
That's awesome.
In the closing costs. And then you've got usually around $1,000 to $2,000 in lender fees.
Right.
That typically is going to go to pay, people that are processing the loan, the underwriters who are working on the loan, other people that are working behind the scenes to help that loan go.
Mm-hmm.
A lot of people used to call those junk fees, I think. And it's like,
I've heard that term.
that money is actually going to pay people who are working on the loans.
Yeah, absolutely. Yeah. Listen, no, everybody's got a family to feed, right?
Right. Yep.
You know.
Yeah. So usually you're gonna see those those fees in there. Typically it's going to be around $1,000, $2,000 between different lenders. And then you've got for other closing fees, you've got prorated taxes and insurance. So like, soon after you go under contract, you're going to talk to a insurance person to get home insurance.
Right.
The lender's going to require you to have homeowners insurance or hazard insurance, it's also called. And they're going to collect 12 months and pay that 12-month premium at closing.
Wow.
So you've already paid for a year of homeowners insurance at closing.
Okay.
But let's say that's $2,000 a year.
Yeah.
That's $2,000 of your closing costs.
Right.
That's coming out at closing.
Right.
And then they're also going to collect money to fund your escrow account. So they're going to pay the insurance company, and then they're going to collect another 3 months of your insurance, of your monthly insurance payments, to start to fund your escrow account to start paying your because when you make a mortgage payment, you've got principal, you've got interest, you've got taxes, you've got insurance.
Yeah.
Right. And now there is an option to waive escrow.
Mm-hmm.
You can waive the escrows and not pay escrows.
Right.
Not pay them through the mortgage.
Through the mortgage.
You're still paying.
You're paying. Yeah, they're not free.
Yeah, you still pay them.
No,
yeah,
it's free.
But you're paying them yourself. So
Right.
like when taxes are due,
you write the check.
You're writing the check.
Yep.
You're paying your insurance company every 6 months or every year, every month, whatever.
What would be the benefit to doing that? Because I always wonder why people do that.
Why waive?
Yeah, like why would you waive and just pay it yourself instead of having it rolled into your actual payment?
Yeah, I mean, I would say a couple reasons. One is just reducing closing costs.
Right.
Because if you're not, you got to think if it's $2,000 for a year of homeowners insurance,
Right.
and then another, I don't know the math on what that would be, like let's say $150 a month.
Yeah.
That's like almost $2,400 right there. And then you've got in homeowners insurance, and then you've got taxes as well, which they're going to collect maybe 3 to 6 months of taxes, depending on where you're at in a year. Or it could be more. They're going to collect those taxes, and so those are things that you're not going to have to pay at closing. And closing is expensive.
Absolutely.
Buying a house is expensive.
Yeah,
moving
absolutely.
is expensive. So, when you're calculating all the costs and how much do I actually have to put down to use, those are considerations, because if you're going to have more money 6 months from now. Then you can pay those taxes in 6 months.
Yeah.
And if you're financially responsible enough to manage paying those things like you do your other bills, on time, then you're good.
Yeah.
And you save money on that. Another reason I would say is for probably most people is just to have that control. I've had people that maybe the mortgage company or, usually like the mortgage company who's servicing the loan, whoever's servicing the loan. Because the company that does the mortgage, 9 times out of 10, they're going to be
They're not servicing
that loan's going to get sold.
Freedom Mortgage just bought mine.
Yeah.
Last week.
Yeah. Or Mr. Cooper.
Right. Because I've had Mr. Cooper too.
Yeah. Cenlar, those companies that service the loans. They basically service that escrow account, and they might take. I had somebody recently who had to call their insurance guy because they doubled what they took for insurance. It was like $3,000 that they collected. Yeah. And so it's
what happened to my bit? Fraud. As soon as they see the bank account.
Yeah. I mean, that was money that got taken out of their account.
Oh my gosh.
And eventually it got put back.
But
it took, I think, maybe a month, 45 days.
Yeah, and if they live paycheck to paycheck, and a bunch of stuff starts bouncing, I mean, that's...
So having that control, where it's like, hey, when this is due, I can pay it, and all the mortgage company is doing is my principal and interest. Right?
Okay.
So also that your payment doesn't change. right? So, your rate isn't going to change unless you have an adjustable rate mortgage, right?
Right.
If you have a fixed rate mortgage, your payment, principal and interest isn't going to change. But if you are escrowing your tax and insurance, your payment is going to vary. Like insurance costs go up, taxes go up, your mortgage payment's going to go up.
Wow.
Because those things are included.
Right.
So just some people, accounting purposes, things like that, they want to know,
They feel like they have more control.
more control if
Yeah.
those things are separated. They can
Makes
see
sense.
like this number's not changing.
Right.
This is our house payment. That doesn't change.
Right.
This is taxes change. This is insurance changes.
That makes sense why a lot of times the individuals that I meet that do that are they're like numbers guys, right? Like
Yeah.
they know in depth of what they're paying monthly for everything and they keep track of it. And it's usually those are the people that I see that actually do that.
Yeah. That would escrow.
Which makes sense. It makes sense. So, to have that control, if you're that type of person where you budget and you want to know what you have and keep control of it, I mean, it's a good way to do it.
Yeah.
So here's the thing, guys. We're here to help you. That's why we're shooting this video. You don't have to use me for real estate. You don't have to use him for lending, but we would love to help you. We'd love to, get that phone call from you, that email, that text. So Tyler, what's a good way they can contact you?
Yeah. So you can email me,
Yeah.
tdavis@thrivelending.us.
Okay.
Or shoot me a text.
Yeah.
I don't know if I should give out my phone.
Yeah,
number.
absolutely.
Yeah. 405-306-6139. Shoot me a text, give me a phone call. Happy to give a quote, strategize. A lot of people, when they get a quote, they're like, hey, can you not run my credit yet? Because they're still afraid that something's
Right.
going to happen with their credit.
Right.
That's totally fine. Just know that you're not going to be fully approved until we actually look at the credit
Right.
and look at everything that's on there, look at the payment history, things like that.
Awesome.
But yeah, happy to give a quote.
And I'm James Dunkin Property Group here in Middle Tennessee. I'm a relocation specialist. That's why I've got my Moving to Nashville channel. Go check it out on YouTube. You're probably watching this video on YouTube. And you can call me, text me, 615-772-7079, or shoot me an email if you're not comfortable with that. It's james.dunkin. It's Dunkin, like Dunkin' Donuts. I always got to tell people that. So james.dunkin@exprealty.com. Listen, we'd love to help you out. Give us a call, text us, email us, whatever, and we're here to help you guys. So we got one more question, guys. It's what are the most common reasons mortgage applications get denied? That's a good one.
Yeah. Well, we've kind of already touched on one, and that is people borrowing money
Find a car in the middle.
whether it's a car or
Right.
anything really.
A refrigerator at Lowe's. I've seen that.
Yeah, I mean, refrigerators get pretty expensive. They
Yeah.
can be almost as much as a car,
Right.
or at least what a car costs 20
Those
years ago.
LG ones of all that technology I got.
Yeah,
That's so
smart
crazy.
fridges,
Yeah.
yeah. But buying things on credit, that's one of the most common things, and people just don't think about it. They
Right.
don't think about
Absolutely.
like this is all good, but I also need a fridge or I need a new car or whatever.
Yeah.
Like the most important thing is talk to your realtor, talk to
Yep.
your mortgage person.
Absolutely.
Like ask them before you
Should I
make
do
any
this?
other purchases. Yeah. And even if it's because you're going to give your bank statements to the lender
For sure.
and if
Yeah.
they see you bought something for $5,000, even if it's cash, they're going to want to know,
Yeah.
hey, what was this? This big transaction that we see on your bank statement.
Yeah.
So you just want to make sure before you make large purchases while you're trying to buy a house. These people are giving you hundreds of thousands of dollars. You
Yeah.
want to make sure that even though when they first talk to you, you were pre-approved.
Right.
They want to make sure when you close, you're still approved.
You're in the same position.
Right.
And also, what about a large deposit? Like because they're going to
source large deposits. Yeah.
I've seen before. So I used to be in the banking business, and I was doing a deal at a bank, and I saw literally where it was like money came from one family to another, and they had to get bank statements from all three of them to see where the funds came from.
Yeah. Yeah. It's definitely important to, I would say, ideally use like before you start the mortgage process, have one account that you plan to do everything out of.
That's good. I
And
like that.
have the money that you plan to use. Now that can't always be the case. Sometimes you're selling a home,
Right.
or you're using the proceeds from that to as your down payment or other costs. But that's accounted for.
Yeah,
They're going to want to see the closing disclosure from that sale, showing that there's enough coming from it to actually support.
And we also see where like a title company will hold the funds. Like if you're you're selling it and then you're purchasing at the same title company, they'll hold the funds and then they'll transfer the funds once the closing happens.
Yeah.
I think you and I had a deal together that was similar to something like that.
Yeah.
Not too long ago.
Yeah. Yeah, so that's key, I would say. And it's, if you have multiple accounts or something's coming from a retirement account or something like that, that's okay. But they just know that they're going to want to source any money that's coming in to the accounts that are being used for the purchase. They're going to want to source any large deposits, see where that came from, make sure it's not drug money or maybe a loan.
Something
Could be a
sketchy.
loan from somebody else. It's like, hey, we're giving you a loan.
Right.
You got this other loan. What's the payment on that loan?
Yeah.
You still qualify with that payment in addition to this payment?
That's true.
That's what they want to know.
Right. That makes sense. Well, awesome, man. Hey, listen, this has been great.
Yeah.
Appreciate you, dude. I always love working with you. Hey, listen, like I said, give us a call. We'd love to help you out. Help you, here's the thing. We can help you sell houses too, not just purchase them, right? So give us a call. Our information is on the screen right now. And hopefully we catch you on the next video.